Welcome back, my awesome people. In today's episode, we will be looking ahead into what the upcoming recession will look like. Many economists and market analysts are suggesting a recession in 2025. But personally, I think the recession will be hitting us hard in 2026. 2025 is currently being supported by governments printing money and people spending less as consumer goods are crazy expensive, especially with Trump tariffs and debt is at an all-time high. There are also many warning signs that show an incoming recession and it is unavoidable. The last recession was back in 2008 due to the housing crisis, then COVID hit and we recovered, and now we are stuck in many different type of bubbles. Debt bubble, housing bubble, student loan bubble, national debt bubble, and more, unemployment bubble. The list keeps going on and on. So because of these bubbles, there will definitely be a recession around the corner. Together, those forces are cooling down economic growth, increasing unemployment risk, and heightening recession fears. For those that believe crypto will be the savior for when a recession hits, could be wrong, as we have seen in the past year that crypto has been following the overall market, especially the tech sector. When the market drops, so does crypto. Cryptocurrency markets notoriously are volatile, are entering the 2025-2026 recession in a much more mature but still fragile state than previous cycles. Crypto markets have seen increased institutional involvement since 2023, thanks to clearer regulations and the launch of the spot Bitcoin ETFs. However, in a recession, risk on assets like Bitcoin and Ethereum typically see investors selling and running away from crypto. If consumer spending tightens and retail investors pull back, crypto prices will fall further. My prediction, crypto could drop below 50,000 if global liquidity dries up, and altcoins will suffer worse due to weaker fundamentals and lack of institutional backing. Projects with real utility, blockchains that serve AI infrastructure, tokenized finance, or real-world asset platforms may get through the recession better, and this could actually be great for crypto as it will shift from speculative hype to infrastructure building. The equity markets have already started showing signs of fatigue. The S&P 500 saw tremendous gains through 2023 and 2024, but in 2025, those gains are under threat. Sectors such as tech and growth stocks, which benefit from low interest rates and speculative enthusiasm, will suffer as earnings slow and rate pressures persist. Financials may be hit by loan defaults and tighter margins, and energy could be volatile to geopolitical risk and demand. And instead of money going to those sectors, it will start going to dividend-paying stocks like consumer staples and utilities, and this could attract conservative investors. And even defense and cybersecurity companies will benefit from continued geopolitical tensions. Global trade is increasingly politicized. The US and other developed economies are adopting more protectionist stances, especially in strategic sectors like semiconductors and green energy. New tariff waves, they're not helping. Tariffs on Chinese goods, specifically on EVs, solar panels, and consumer electronics, are rising again under national security pretenses, and retaliation is likely from China, potentially targeting US agriculture or tech companies. Companies are moving operations from China to friendlier countries like Vietnam, India, Mexico, and this is called it's a trend called friend shoring, and this restructuring is expensive and contributes to inflationary pressure in the short term. Even amid downturns, certain sectors defy gravity, and AI is one of them. AI will still thrive because of productivity, where companies look to AI to cut costs and enhance efficiency during lean times. The only challenge with AI are its energy demands. AI models require massive computer power, straining energy infrastructure and cloud providers, and this will be the next hurdle that governments need to deal with. So when thinking of the future, heavy amounts of energy and money to produce will be the main key. And until then, it can be rocky for AI until then. The coming recession won't be a mirror of 2008 or 2020. It's a complex downturn shaped by technological disruption, supply chain realignment, shifting geopolitical alliances, and lingering post post-pandemic distortions. Key strategies for investors before the recession hits is to diversify across assets. This means owning cash, bonds, commodities, and various equities. Focus on fundamentals of quality companies with strong cash flows. And what could be a great opportunity is to look global, because some emerging markets may offer great value. Recessions, while painful, are also inflection points. They clear out excess, rebalance the system, and make way for the next wave of innovation and growth. Those who prepare not just financially, but intellectually will be better positioned on their side. So a recession could be good. So Jacob Rant, are you prepared for the upcoming recession? Well, my awesome people, if you are currently watching this video, then you probably remember the disaster of an economy that we had during COVID. So think of that time as a one-of-a-kind, unexpected recession. United States and Canada, like much of the world, is bracing for a potential recession in 2026. Signs include slowed GDP growth, declining consumer confidence, and tighter monetary policies. The Bank of Canada's previous rate hikes to combat inflation have cooled borrowing and spending, affecting sectors like housing, manufacturing, and retail. Canada's economy is especially vulnerable due to its high household debt, a cooling real estate market, and reliance on exports, especially to the United States and China, both of which are also facing economic headwinds. Falling demand for oil and natural gas, coupled with supply chain tensions and possible trade disruptions, further threaten economic stability. To weather this downturn, you can take these several steps, and these are steps that I will be taking. 1. Build an emergency fund. Aim for 3 to 6 months of living expenses in a high-interest savings account. Cut discretionary spending. Trim non-essential costs and prioritize needs over wants. Pay down high-interest debt. Focus on credit cards and variable loans to reduce vulnerability to rate hikes. Diversify your income. Side gigs or freelance work can provide a buffer against job loss. Invest defensively. Shift to more stable assets like consumer staples, utilities, and dividend-paying stocks, or increase your fixed income exposure, such as getting a promotion or a raise. And most importantly, stay informed. Monitor economic indicators and adjust your budget or investments as needed. Though recessions are challenging, they're also temporary. Smart financial planning and adaptability can help Canadians not just survive, but come out stronger. Now, I want to hear from you. Are you prepared for the recession? Drop a comment below and let's discuss. And don't forget to like and subscribe if this video gave you some value and insightful content. And remember, my awesome people, just like all the information I mentioned in my videos, always assess your risk appetite, always diversify, and please do your own due diligence, because I am just a clown on YouTube. Stay ranting.